This just happened, and most high earners still have no idea it's hitting their paycheck. If you earn more than $150,000 a year and you're 50 or older, the rules of your 401k catch-up contribution changed on January 1st. The IRS finalized the regulation last September, and it could quietly cost you between $2,000 and $4,000 extra dollars in federal taxes this year alone. Here's what changed, who it hits, the one workaround that still works, and the number I want you to pull off your W-2 before you close this video. Back in 2022, Congress passed a law called the Secure 2.0 Act. Buried in it was Section 603, and Section 603 says, if you're 50 or older, and your prior year wages from your current employer cleared a certain threshold, your catch-up contribution can no longer be pre-tax. It has to go into the Roth side of the plan, meaning you pay the tax today, not in retirement. The rule was supposed to start in 2024. It got delayed to 2026. Plan sponsors were still hoping for another delay. Then on September 15th, 2025, the IRS released the final regulations with no more delays. The rule is live. It started January 1st. It's flowing through payroll right now. Quick note before we go deeper, this channel is educational. Nothing here is tax or investment guidance for your situation. The numbers are accurate as of this recording, but your plan, your employer, and your own tax picture matter. Talk to a qualified professional before acting on anything you see in this video, okay? Here are the 2026 numbers you need to know. The basic 401k employee contribution limit for 2026 went up to $24,500. That's the normal deferral cap for anyone of any age. If you're 50 or older, you can add an additional $8,000 on top of that. That's the standard catch-up. And here's a piece that's brand new for 2026. If you're between the ages of 60 and 63, you get what the law calls a super catch-up. That one is $11,250 on top of the regular limit. So a worker age 61 can theoretically put in $35,750 of their own money this year. Now, here's what most people miss. The Roth catch-up rule applies only to that catch-up portion. It does not touch the regular $24,500 deferral. That can still be pre-tax for anyone at any income. It's only the catch-up that has to convert to Roth for high earners. And who counts as a high earner? The statute said $145,000. That threshold indexes with inflation, and the IRS confirmed in Notice 2025-67 that for 2026 the number is $150,000. The test looks at your 2025 wages, and specifically Medicare wages, which is box 3 on your W-2. If box 3 from your current employer was above $150,000 last year, you're in scope this year. Let me be direct about this. A lot of the coverage I've seen is telling savers this is a disaster. It's not a disaster, but it is a shock because it shows up on your paycheck before most people realize the law even changed. Let's run the numbers. Say you're 55, you earned $175,000 in 2025, and you plan to max out your $8,000 catch-up this year. Under the old rule, that $8,000 goes in pre-tax. If you're in the 24% federal bracket, you save roughly $1,920 in federal tax today. Under the new rule, that same $8,000 has to go in as Roth. You pay the full 24% on it. Same $1,920, but now it moves in the opposite direction. Instead of a tax break this year, it's an extra tax bill this year. Stretch that to the super catch-up. If you're 61 in the 32% bracket and you max the $11,250 super catch-up, the Roth requirement costs you about $3,600 of extra federal tax this year compared to the pre-tax version. That's the part people are feeling right now. They're staring at their pay stubs asking where the extra withholding came from. It came from Section 603. But hear me on this. The money itself is not lost. The math is a trade. In the old pre-tax world, you deducted that catch-up today, and in retirement, every dollar you withdraw, principal plus decades of growth, gets taxed at your future bracket. In the new Roth world, you pay today, but every dollar that comes out, principal plus decades of tax-free growth, is yours, free and clear. And under the current version of Secure 2.0, the Roth portion of a 401k does not face required minimum distributions during your lifetime. Think of it this way. The old catch-up was a gift wrapped in a future tax bill. The new catch-up is a tax bill wrapped in a future gift. Now stay with me because the question everyone needs answered is, does this hit me? There are 4 groups to check. Group 1, the clear target. You're 50 or older, you worked for the same employer all of 2025, your box 3 wages from that employer cleared $150,000, and your plan offers a Roth option. You are in scope. Your catch-up this year must go to Roth. Group 2, the same employer trap. This is the one nobody's talking about. The rule looks at wages from your current employer in the prior year. If you switch jobs between late 2025 and today, your new employer looks at what they paid you in 2025, which is usually 0 or a partial year. If that amount is under $150,000, you are not subject to the Roth requirement in 2026, even if your total 2025 income was well above it. The new employer starts the clock fresh. This is a real legal workaround for a subset of job changers, and the clock flips in 2027 once they have a full year of your wages on the books. Group 3, the self-employed. If you run a solo 401k as a sole proprietor and you don't pay yourself a W-2, you don't have FICA wages the way this rule defines them. Those earnings are generally exempt from the Roth catch-up trigger. But if you're an S-corporation owner paying yourself a W-2 above the threshold, you are subject. S-corp wages are FICA wages. That trips up a lot of business owners who assume self-employment means the rule doesn't apply. Group 4, savers whose plan does not offer Roth. The final regulations let an employer pick a different path. Instead of adding a Roth option, a plan can simply eliminate the catch-up feature for everyone. If your plan took that path, you have no catch-up available through the 401k this year, high earner or not. You can still use an IRA or, if eligible, a health savings account, but the 401k catch-up bucket is closed. Most large plans are adding Roth. Some smaller plans are not. Which is why one of the most valuable things you can do this week is actually read your plan's 2026 summary of changes. Here's the 3-step checklist to run through today. Step 1. Pull your 2025 W-2 and look at box 3. Not box 1, box 3. Box 3 is Medicare wages, the same measure the IRS uses for this rule. If box 3 from your current employer was above $150,000, you're inside the rule for 2026. Below, you're outside, and your pre-tax catch-up still works for one more year. Don't guess. Look at the number. Step 2, log into your 401k portal today and check 2 things. Does the plan offer a Roth contribution option? If yes, you're fine. The catch-up will flow into Roth automatically for covered employees under something called a deemed Roth election. If no, ask HR directly. Is the plan adding Roth for 2026, or is it eliminating catch-ups entirely? Both answers change what you do next. Step 3. Do the real math for your bracket, not a generic calculator. Your bracket. Here's a simple frame. Take your catch-up amount. $8,000 for standard, $11,250 for super. Multiply by your current federal marginal bracket. That's roughly the extra tax you pay today under the Roth version. Then ask, 20 or 30 years from now, what will my retirement bracket look like? If you expect your future bracket to be lower than today, the pre-tax version was the better deal, and the Roth requirement genuinely cost you. If you expect your future bracket to be roughly the same, the two are close to a wash. And the Roth actually wins on the back end because of no required distributions. If you expect your future bracket to be higher, and for a lot of high earners with RMDs, Social Security taxation, and Medicare premium surcharges, it often is, the Roth catch-up is probably the stronger choice, even with the upfront hit. The point is, don't react to this emotionally. Run your bracket. Then decide whether to keep the catch-up, dial it back, or redirect those dollars somewhere else this year. Zoom out with me for a second. The bigger story here isn't Section 603 by itself. Since 2022, almost every piece of new retirement legislation has been pushing the American retirement system in the same direction. Toward Roth, toward paying tax today, away from the old deduct now, pay later model that most of us built our plans around. If that's where the law is heading, the savers who win are the ones looking at their whole plan through that lens, not just the 401k catch-up, but IRA strategy, conversion strategy in the pre-RMD window, and how they sequence withdrawals once RMDs hit. We did a deep dive on exactly that, a step-by-step framework for Roth conversions during the pre-RMD window, in one of our recent long-form videos. I'll link it in the description and in the card above. If you're 50 or older, and you're just now hearing about Section 603, that conversion video is the next thing to watch. And if you want a no-charge second look at your own numbers before you make a catch-up decision this year, the link to schedule a free consultation is in the description and pinned in the comments. If this helped clarify a rule that's affecting your paycheck right now, hit subscribe. We publish new retirement education every week. See you in the next one.
Hey, before you go, if you're serious about your retirement, we'd love to help. Scan the QR code on screen right now or visit the link in the description to book a completely free strategy session with a qualified professional. It only takes a couple minutes to fill out, and there's absolutely no obligation. Take the first step today. We'll see you in the next one.